You know that moment when you're completely sure you're right, and then reality hits you in the face. Like when you thought your business was worth 10 million and 3 investors in a row tell you that the value is really at about 3. Or when you're certain your team is aligned behind the strategy and then your VP of sales quits without warning. Or when you've been celebrating 20% growth and a potential acquirer tells you that's not even table stakes anymore. That sickening feeling? That's the moment you realize you've been living in an alternate reality. And the gap between what you thought was true and what actually is true just cost you around a funding or a key employee, an exit opportunity, or maybe the whole business. And here's why that terrifies me, because that moment usually comes too late. By the time you get the wake-up call, the damage is done. Your competitors have moved past you. Your best people have checked out. Your valuation expectations have made you uninvestable. And the market shifted 3 years ago, but you were too busy measuring the wrong things to notice. Today, in this episode of the Business Emergency Room, we're talking about how to catch that misalignment before it becomes a business emergency. How to see those symptoms early and what they are, and what to do about it while you still have options.
Leadership today isn't just about scaling. It's about navigating constant uncertainty, market disruptions, and high-pressure decisions. If you're dealing with chaos, bottlenecks, and relentless pressure, welcome to the Business Emergency Room.
Welcome to the Business Emergency Room. I'm Maartje van Krieken, your host, and this is where growing businesses come when things get messy, or better yet, before they become full-blown emergencies. Today, we're talking about one of my other favorite subjects, reality, or rather, the reality check. How do you set yourself up to actually see when your internal story about your business and the external market reality have stopped speaking the same language? What are the symptoms visible inside your business that scream misalignment? And most importantly, what do you do about it before it kills your ability to raise capital or exit successfully or even survive? And this is why I care so much about this. I don't want to see businesses with good products and services that are very much needed in today's world go under because of reality issues, right? Because of living in alternative realities. I don't want to watch talented teams implode because leadership was measuring the wrong things. I don't want another founder to discover on the day that they desperately need capital or want exit that they've been building in a fantasy world. All of this is preventable. This is diagnosable. And that's what we're going to do today. Diagnose it and fix it. Treat it. Let me tell you what I'm seeing on the front lines. I've seen former startups that have scaled to mid-market B2B companies coming to me for crisis intervention, right, on a regular basis. And when I dig in, it's always so clear that the crisis really didn't start yesterday, right? It's been a slow buildup over years. And the misalignment between what they thought they were building and what actually has value in the market has grown silently, invisibly, until that is suddenly a catastrophic gap. Sometimes also, you are very investable today, and then life happens. Like a founder gets sick, or partners disagree, or the market shifts drastically, and suddenly the value story you've been telling yourself, it doesn't match reality anymore either because of something that happened recently or today. Or maybe you've not been investable for 2 years, but you just didn't know it because nobody's telling you the truth, right? That also happens. Your team isn't pushing back because they're giving up. Your dashboard is green because you're measuring activity, not outcomes. And you raised money 18 months ago and you're still making decisions as if that valuation is real. The data backs this up. Because most founders surely overestimate their company's worth due to emotional attachment. And the funny thing is that it's not really just founders, right? A committed C-suite does the same thing, is equally emotionally invested and attached, leading to unrealistic expectations. Equally, leaders and founders tend to be optimistic and passionate about their vision, about basing valuations on future projections and emotional attachment to that, or believe in that, whilst investors base valuations on current performance and comparable product at work, and at risk, right? A future risk profile and a current risk profile. And in the US, nearly 25% of venture rounds were flat or down in 2024. And that number is probably higher for 2025. Whilst the 2024 number was already a decade high, right? So that number is increasing. That's 1 in 4 companies facing a down round. And in Europe, those down rounds represent almost 20%. So similar numbers. And those are just the companies that manage to raise at all, right? If you don't show exceptional growth, your valuation will increasingly diverge from market norms, leading to more meetings and more rejections. But here's what's even more insidious. The misalignment doesn't just affect fundraising. It affects your strategic decisions, your hiring, your pricing, your partnerships. Only 28% of executives and middle managers responsible for executing strategy could list priorities explicitly, yeah? And duplicated initiatives occur everywhere as company divisions drift off into self-directed mode, and then they're straying from the corporate goals, working very hard on what they believe is the right thing. You think you're maybe aligned, you think you're building value, but you're also operating in a volatile, uncertain, complex, and ambiguous world with information coming from every direction. And in that noise, it's really hard to read and see the signals. So today we're going to do 2 things. First, we're going to go diagnose the symptoms, so talk through the symptoms of having a misalignment in your reality check, right? Or needing to do better and an updated reality check. And second, then we're going to give you 7 treatments. I'm going to give you 7 treatments, taking it back to those symptoms, practical tools that you can deploy today to catch that misalignment before it becomes a business emergency and actually do something about it. So let's start to the symptoms. I want you to listen to these 7 symptoms carefully. You don't need to actually suffer from all 7, right? You don't need to, they don't need to all be relevant to you to still have a problem. If you recognize even 2 or 3 of these in your business, you've got misalignment. And misalignment left untreated is what kills good businesses. So, in no particular order, symptom number 1, the silent symptom. This is where you ask, how's everyone doing? And you get all hands and get thumbs up. The turnover is climbing. You know, typically 2/3 of your executives feel part of your business and feel part of something important. If you go down to the regular workforce, that drops to 60. And in fast moving businesses, that number is typically lower. If you have your best salespeople not pushing back on new structures or ideas, it may also very well be not because they agree, because they're quietly interviewing elsewhere, right? So they're already switching off. Your KPIs on your dash could all be really green, yet your deals are slipping, and customers are mentioning competitors you never heard of. So things you may not measure anymore. 40% of executives feel highly burdened by information, but you still can't answer, are we creating value whether customers will pay for tomorrow, right? So filtering through that to get the right steer is hard. So what it looks like is in a startup maybe is the first engineer leaving while your user growth chart trends up. In a larger business, it might be looking like your VP of sales is going silent in strategy meetings while activity metrics look healthy. And that quiet feels then like buy-in, and the green dashboard feels like progress, but both are illusions. The challenge is compounded, I think, by hybrid work. And those of you who are regular listeners know that I totally believe in remote work and hybrid teams, etc. The truth, though, is as a leader, you are going to hear less of the gossip, right? You're going to pick up less of what is really being said. And if you don't explicitly ask for things, how are you going to get the feedback of what's happening in the market? How are you going to get the information that comes up through the coalface? The silence is typically a first sign that things are maybe not as they should. People are not saying what's wrong. They're also not saying they're super happy. They're just kind of starting to disconnect. So symptom number 1 is the silence. Symptom number 2, the valuation hangover, I've dubbed it. Maybe you raised 50 million or got appraised at 4 times EBITDA 18 months ago. And you're still making decisions today based on that number. But the challenge is that setting valuations too high creates unrealistic expectations for the next round. As I said earlier, many venture rounds, or a quarter of venture rounds these days, are flat or down in the US, and it's about 20% in Europe. That's significant, and that number is growing. And what I see is that startups hire like they're worth their last round price. And mid-market companies set M&A expectations based on peak multiples from maybe 2021. But that number was an optimistic snapshot. You're treating it like a permanent reality. And just because that was the number that you fundraised again, that's not necessarily the number that's valid today with what you did since. Yeah. And so treating that as a hard truth, and still making decisions on numbers that are over 18 months old is a problem. Then, symptom number 3, it's always worked before. When you suggest to update a model or a pricing strategy, for instance, and you get this reaction, right? But we've always done it this way. The challenge is that especially when things become more volatile and uncertain and complex, as they do in the current world, people cling to status quo for immediate comfort, right? That's our human survival system. And so the challenge is then that we're in this world. So what you're seeing is you're in a world where there's too much information and too much feedback, and not knowing what to decide or what to work on. And we reach back to what we know. And so what that might look like in your organization is that you keep adding features to a product when customers are actually asking for simpler implementation and better support. Or you might be running the same trade show playbook while buyers have moved to digital research, right? And are looking for you in a very different way. Basically, you're then perfecting a strategy that the market has already abandoned because you've always done it this way. So how ground in actual feedback is your planning, or is it based from what you bring from within? Symptom number 4. It's the whiplash from the investor-buyer meeting. So you pitch investors or M&A advisors confident, but then you leave confused by the questions. It's very normal that founders overestimate their company's worth due to that emotional attachment that we also talked about earlier. The challenge is investors base valuations on current performance and comparable companies. Startups think their tech is typically worth millions, whilst investors don't see those millions, but more unproven revenue. And mid-market B2B thinks that maybe 20 years of relationships justify premium multiples, whilst what actually the buyer sees is customer concentration risk and aging contracts. And the gap between what you think you're worth and what they'll pay is widening because of it. Symptom number 5, the if I got hit by a bus denial symptom. Have you in your stress, well, it's actually unlikely, most don't, we know that for a fact. You've unlikely ever stress tested what happens if you or your co-founder or any of your other critical leaders in your team can't work. So death, disability, divorce, disagreement, distress, they don't directly impact value, but they do impact leadership continuity and execution capability, which then in turn impacts value. Much more so than we think, right? We often talk on this podcast about work being attached to individuals too much, about what happens when you lose key individuals and the value erosion and disruption that happens to your business. We talk about it so much because it's real, because we don't want to think about these situations and think we're invincible until it happens. So is all your product knowledge concentrated in one or two individuals, right? Or are the key client relationships all held by one individual? Basically, your one health crisis or partnership blow up away from discovering that your business is worth a lot less than you think. So did you do a reality check? Where are you on if there's something happens, if anyone in your organization gets hit by a bus? Symptom 6, we're growing, but not fast enough. So startups that celebrate a 25% year-on-year growth, right? Fabulous. The challenge is early stage startups these days need 50% plus as a baseline. Anything lower raises red flags. So although that look massive and they have taken a massive effort, it's not seen that way by others. So you might feel successful. Unfortunately, it's not enough. Pre-seed startups now need revenue, right? Mid-market B2B, if you hit 12% growth or stable 20% margins and think that's solid, challenge is the rule of 40 says that growth rate plus profit margin should equal 40% plus for healthy companies these days. And top quartile companies generate nearly 3 times the multiples of bottom quartile. So the range has increased drastically and the definition of success has changed. So if you are measuring yourself against yesterday's benchmarks, right, or what good looked like in 2022 or 2023, I'm sorry to tell you, but the market has moved the goalpost. Symptom 7, last but not least. We call it the Cold War between partners and shareholders. So internal misalignment in leadership. You and your co-founder or partners develop different, but this is misalignment that we don't know about, right? Or that's not so visible. So this is about you and your co-founder or partners potentially developing different views of the company's worth and strategy. And each building your own narrative with supporting numbers. And then internal valuations drift apart as each party gravitates towards assumptions that support their decision, right? So this is confirmation bias. Once we've anchored around something, we're trying to find more numbers and arguments that support that we are right or that our view of the world is right. And so this is where there's conflict, but there's also mixed potential for conflict going forward. If different parties think there's different money to be had here and different opportunities because of different valuations, it's also a problem because there's different and mixed messaging going out in the world, and your partners and or advisors or decision makers are responding to whatever version of the story they're hearing. Yeah. And the challenge is nobody's reality is necessarily wrong. The question is how objective are they? But they could be very different. And we're all seeing the version that proves us right. So again, if you recognize yourself in 2 or 3 of these symptoms, you're not alone. If you recognize yourself in quite a few of these, we definitely need to talk because you might not really be in the self-help stage anymore. But here's the good news. It's very normal to suffer from some of this. I think it's diagnosable. It's totally treatable. And you don't have to keep operating with a gap between what you think is true and what actually is true. I do wholeheartedly believe, though, in today's day and age, this VUCA world, you're going to need to go after this. So I'm going to give you 7 treatments, 7 practical tools to build that reality checking system into your business. Let me be clear. I'm not saying you should all of these 7 tomorrow. That's not realistic and it's not necessary. What I'm suggesting is that you try each of them at some point, because I think they're really useful tools to look at your business with, and experiment a bit. What I want you to deploy is the treatments that you need most today based on those symptoms that we just talked about, right? Let's talk through these treatments, and I want you to think about which ones is going to be most helpful for you to start deploying today or tomorrow. Treatment number 1. This is about that silence, right? What I want you to do is consider putting some kind of quarterly pulse in place. Make it anonymous, but do it both on your metrics and your people, right? Run some kind of survey, asking your team and your people, what are our 3 strategic priorities? Questions like, do you believe we're winning in the market? And then also do a reconciliation exercise. Look at the green metric, every green metric on your dashboard, and ask if this metric stays green, but if revenue declines 20%, what does that tell us, right? Force yourself to identify the leading versus the lagging indicators. I also want you to include questions like, what are we missing? Maybe in the survey you want to ask about what's the feedback from the market or suppliers that you're hearing? What's the one thing that you've read about in the last month or the last quarter that you don't see us dealing with, but that you do think matters to our market? Try and ask for that feedback and then show what you're doing with it, right? Invite people to bring up things before they decide that it's not going to matter and go silent. What you want to do is create some effective feedback loop and communication loop so that you can fix alignment because you're measuring it, or you have a chance of finding it. And you can make this very quick and simple, right? And put in a little reward for participation and say, hey, whoever submits the survey, we'll raffle off a gift card of some kind or whatever to just get it done, or reward the funniest or the best idea or best suggestion or whatever it is that you want to do. Treatment number 2, the annual independent valuation. I think this is a non-negotiable. I think you want to do this. I think the scale is negotiable. Doing this is not negotiable. So this is about the valuation hangover. I think every business should have a valuation performed at least 5 years before planned exit. Well, I don't think that's just best practice, but I think you also need to do something annually. I think this is an excellent thing to do before you have your strategic planning update and your budget conversations and stuff, because you're going to get some excellent feedback out of this, where you are currently leaving value on the table in your business. And so it should help lead to focus. I think you should use an independent firm. You can have a whole valuation done, or you can bring in a consultant or somebody like me, or a more financial oriented individual to look at your business from anywhere from a couple of hours to an in-depth analysis. And you're going to get some feedback on where you see the value of your business and where there's a disconnect from how a potential buyer or somebody looking from the outside in sees it, right? And if you do this every year, you can see it going up or down. So you get some trends. You can also see where you're not improving. It's also true that if you do this, or companies that do this really do see their value increase because they're actually closing these gaps, yeah? You also get a good reality check on where you're just simply over optimistic and you can never close that gap, so you can stop working on certain things, yeah? Or make smarter proposals and smarter pitches for future fundraising rounds, etc. Treatment number 3. This is about it's always worked before. This is a bit of a game, and some of you might like this and some of you might not, but I see great value in in putting a challenger in, or somebody in a challenger role. So what I think you should have is a quarterly or once or twice a year kill your strategy session. So assign someone on your leadership team to argue why your current strategy is obsolete. Make them build the case, right? Give them a bit of a time limit. You don't want this to become a massive exercise, but use customer feedback, competitive moves, market shifts to say, this is why our strategy is or could be completely wrong. Review what changed in the last 90, 180 days or year, not what you did, but what changed externally that might invalidate your current assumptions. Things to ask yourself is, what if we're starting from scratch today with what we know now? Will we choose this strategy? Will we do something completely different? So again, this is, I think, good pre-work that could feed into your annual strategy work. And if it's hard for anyone to find somebody internally who has the kind of mindset to do this, you can also invite somebody in. It's typically harder to hear for you somebody else break it down than somebody who sits in it, who's in it, and you believe really understands all the nuances of your business, which is why I'm suggesting that somebody internally tries to take on this role. So it's basically just an exercise in looking at your business a different way, and you can facilitate this or gamify it as part of your strategy session. But this is about accepting that we cling to status quo for immediate comfort, right? And that we need to push ourselves out of that and kind of leave some of these boundaries behind. And if we do that and then look at the same thing, would we make different choices so that we realize where we're anchoring ourselves for comfort and safety rather than because it's the right choice? Treatment number 4, benchmarking. I want you to do more in looking at peers and looking at others, and regularly, right? The changes and the shifts in the market are such that whatever was true 18 months ago is no longer true today. This will help you with both symptom number 4, the investor-buyer meeting whiplash, but also with your growth expectations. So that was symptom number 6. What I want you to do is find 5 to 10 companies at your stage in your sector that have, preferably recently raised or been acquired or had some kind of public event so that there is data available, or get somebody in who benchmarks companies and has that data set, right? Normalized. They might not have names attached, but who can do this for you. And then calculate your rule of 40. Your revenue growth rate and your profit margin should equal 40% or more. Yeah. And if you're a top quartile SaaS company, they generate nearly 3 times the multiples of those in their of those in the bottom quartile. Yeah. So you need to understand the multiples in your sector right now, not 2 years ago, right now. And if you're significantly different from your comparables, you need to either justify why or adjust expectations. And in my real world, that justification typically falls short, right? So can you truly justify that your numbers are so different? The challenge is that we inside the business base valuations on future projections and emotional attachment, and our biases are overly optimistic about what we can achieve. And somebody from the outside looking in will measure you against your peers, will use exactly that same method. So why would you not use it to figure out where you can improve value in your business, where and how you should be able to improve your performance, or you're maybe in the wrong space because somebody else is doing it or so many others are doing it so much better than you. So stop guessing and start actually figuring out where the cogs in the system are that need tuning, right? So benchmarking is a very relevant tool. Again, it's very scalable, right? You can do it in many different ways, make it fit for purpose for your industry, your segment. Maybe start smaller and then branch out once you get the hang of it. You can do this in many different ways. Treatment number 5, the 5 Ds stress test. So this goes back to the if I got hit by the bus, or if somebody else critical in my organization got hit by a bus. I want you to wargame these 5 D's, right? And wargaming it might, for, whether you have somebody in the business who goes out for death or disability or disagreement might look similar. If you're a partner owner, the scenarios may look very different between death and disagreement. So you might not need to wargame all 5 differently. I want you to do it though for all key positions, right? What if we lose an individual in these positions through either disagreement or they're no longer there available? What would happen? Because disagreement and somebody moving on to another business or still being around and working actively against you, we never believe it happens, and then it happens, right? Equally, financial distress, right? That works differently for different people in different positions, depending on how people are remunerated and how packages are done. Who holds the critical relationships? Who has irreplaceable knowledge? Where are these single points of failure that if somebody's out, that would lead to major business disruption? You need to create succession plans. You need cross-training programs. You need relationship redundancy. And you don't need it someday. You need it today. And this is a conversation you can have internally. That's not always easy. Sometimes it's easier to, particularly valuation advisors or M&A advisors are quite used to these kind of conversations. They try to make you express it in numbers. If you want to more organizationally have a conversation about how do I manage toward this and put some stuff around it, and you want to brainstorm about it, then somebody more in my space might be a more relevant partner to talk this through. There's also plenty of examples out there of how you can do this. But you need to do this work with a few key people in your organization, and you also need to look at your board members and see how some of the critical relationships can be affected by the same, right? So your main suppliers or your main clients, if you're very dependent on a few. Do you have a client relationship that only works because there's one person on the other side in their organization who knows so well how you work that interface only works because of those two individuals or that individual? That's a challenge for you that could trip up your business, although that individual doesn't even work for you. Yeah. Treatment number 6, the VC method, back calculation exercise. So this brings back to the valuation hangover or the investor buyer whiplash. Have a look at your business, thinking like an investor and not a founder. What do you realistically think you'll exit for in 5 to 7 years, right? Imagine that you're back in this pitching stage and you need to put numbers behind it and work up these evaluations and have that story together. When's the last time you updated that story? When is the last time you thought about it in the language and the ears of an investor, what they want to see and hear? And if you don't like what you're coming up with, that's a clear indication that there is a gap to close, or you need to make some big decisions regarding your strategy and the future of your business, right? A significant divergence between the VC method valuation and other methods can signal potential misalignment between founders' views or company's worth and return potential. Fundraising valuations depend on projections and forecasting. Exit valuations are largely based on actual performance of your company to date. And that's why it's such a useful method to look at your business in a different eye. Because you're pitching on dreams, but you're selling on reality, right? When you're exiting. So doing exercises like this, forcing yourself to work through one of those methods and put numbers to things and arguments to things, breaks the emotional attachment and forces you to see your business through the cold lens of returns math. And if the numbers don't work, well, no amount of vision can change that. Then treatment number 7, the pre-scheduled state of reality review with a neutral third party. So this is particularly with regards to symptom number 7, when you think the partners and shareholders might be looking at your business through different lenses. You want to actually prevent that. So even if you're not there, this is a conversation you want to have on a regular basis. And what I want you to do is schedule a periodic review, every 6 months, once a year, not less in the current business climate, with someone who has no stake in the outcome of the company. So an advisor, a board member, or a valuation expert, and bring the competing narratives and numbers to the table. So invite your key individuals to say, this is why, if I need to summarize the performance and the state of the business in one slide today, this is what I would put up, and have everybody bring those slides, and then have a look at where the differences are and how people came up with these numbers and why are they thinking that way or looking at the business that way, and what's supported by facts and what's maybe optimism or bias or negotiation dynamics, right? So which were numbers or things that we used in a certain context to facilitate certain conversations, but they're not the right numbers to now make different decisions elsewhere in the business, right? Because they were geared towards the one thing, not towards, right? It's same as the numbers that go in the tax return are not the numbers that you're using to steer or direct your business on a day-to-day basis. They're numbers categorized and clustered in different ways for different purposes. So use that same approach and say, okay, hey, and the value here is in that conversation, right? To understand where everybody's coming from, and ensure that you might not entirely, depending on how often you do this, how much time you have. I'm not looking for the most granular level of alignment, but it really does allow you to catch these major gaps in views of what the world looks like. Yeah. All right. So 7 symptoms and 7 treatments. The challenge is, what kills businesses is not the market. It's not bad luck. It's not even those 5 Ds, like the death and divorce and disability and disagreement. What kills businesses is misalignment between what you're building and what has value, and not knowing about misalignment therein until it's too late. Because you can work 80-hour weeks and you can build the most elegant technology and you can have the grandest vision. But what if you think creates value and what the market's rewards aren't aligned? You're building a house on sand. And when life happens, and it will, that house falls fast. I've been doing this long enough to see the pattern. Those who succeed aren't necessarily smarter or more talented. They're the ones who build systems to stay tethered to reality, right? They do that check-in. They have those feedback loops. They have their finger on the pulse. They're the ones who measured what actually mattered. They're just not just what's easy to measure, right? And they're responding to what's happening. They have shorter planning timelines, or timelines that are relevant or commensurate with the pace of the world around them. And they're the ones who got independent perspectives before they desperately need them then. The treatments I gave you today are not complicated. They're not expensive. All of them are scalable and can be made fit for purpose, but they require something most founders struggle with, which is the willingness to be wrong and the willingness to invite a fresh perspective and the conversation, and the humility to admit you might not be seeing things clearly or at all. And the courage to ask for an outside perspective that might challenge everything you believe about your business, with the intent to help you make your business stronger, though, right? Valuation experts talk about this all the time. When they're brought in to resolve shareholder dispute or prepare companies for exit, what they find is that the internal valuations have drifted apart because each party gravitates towards assumptions that supports their view and positions. And nobody's seeing reality objective anymore. They're seeing the version that proves that they're right. So don't wait until you're in crisis to get a reality check. Don't wait until your fundraising gets rejected or discover that you're measuring the wrong things. Don't wait until you want to exit and find out that your business is like worth half of what you thought. Until next week, stay sharp, stay real, and catch the misalignment before it comes to an emergency. If you want help, give me a call, drop me an email. I'm here. We can talk about it for an hour. I come in and facilitate something. Or you can go back through the list and do some work on this yourself. The only thing that's not okay is if you do nothing. See you next week. Thanks for tuning in. Bye now. That's it for this episode of the Business Emergency Room. If you are currently dealing with chaos or disruption in your business, please reach out. You can email, text, or call, and I will find a way to connect with you within 24 hours. I've helped others steer out of the storm, and I know I can help you too. Talk soon. Please like, subscribe, and share.